Hello, Warriors. A little bit of oil news on Live Squawk. British Petroleum to pause oil tanker transits through the Red Sea. Then the UK Navy reports an explosion. And then this came out. A lot of these tankers are rerouting. Everyone's avoiding the Red Sea. So could be a good reason for crude to continue a bear market rally, right? So good morning, everyone. Hi, James Groom, Michael Weissman. How are you? Kman, AJ, Ryan, Kurt, Paul, Joe, Mike, everyone else, team. How you doing?
Good morning, Coach.
How are you, man?
That was a yawn.
So here we are, holiday week. What do you make out of Friday's action, Ryan? Good morning to you. And can this double top be taken out?
Yeah, of course it can. It's possible, especially this time of year. The market, it's been a weird few days. We had all the FOMC turning dovish, then we've had all the Fed heads coming out. Well, a couple of Fed heads coming out, sounding hawkish. Williams straight after, knocking back cuts. Everyone's knocking back early cuts. Literally every ECB member that comes out mentions March is too early, and it's pretty much the same for the Fed. We had Bostic, who's one of the doves. He was one of the loudest shouting for a pause and a peak in rates. And even he's only gone for 2 cuts next year, where the median's 3. So there's been a bit of a pushback. Very strange, to have the headmen or the headman coming out and being relatively dovish, and then all the underlings, particularly some of the doves, coming out and being less dovish. So you can make up your mind what communication regime they're trying to put in place over there.
Yeah, I
But,
mean, are they running the market, or are
the market
market participants running the market, and are they just trying to keep up with what the market's doing? So with them hollering here at 390, maybe we'll finally get some type of bounce. We haven't had a bounce, but I think that we're pretty close to that, the head and shoulders top that was in the 10-year yield here. I think even if you take the neckline here, that we're getting close to some objectives for this first move. So
that 10-year might be the key for your euro dollar run to 110. If it holds this 389, 390 level, then the dollar could bounce. That will send obviously the euro lower. But if that breaks, next stop might be 370, and then we'll probably see euro dollar up at 110 again.
Okay. Aussie continues to hold up better, outperforming. Don't you think? I mean, compared to the other two. I've seen targets at 68, 67, 90, 68. So
very possible.
We'll see what happens there. Any feel for anything else? Any feature like the yen here? Looks like looks like a 1-2. Think we rally this week, get some more upside.
I'm not surprised to see it up today, given the pushback by Fed members, but we're in the Bank of Japan realm as well. So the market just might be squaring up some of those hawkish positions that they had on the over UEDA a week or so ago. So it's going to be jumpy. If they're unchanged, I wouldn't be surprised they're up 143s, 144s, unless there's some hawkish notes in the comments.
Okay. Hi, Kman. How are you today?
Hi, Dale. Hey, everybody. Yeah, I'm doing fine, thank you.
What's top of mind?
EURUSD, Aussie holding up better. I'm not playing it via the Aussie dollar because I found this whole ballet of Yellen, then FOMC, then Goolsby, Williams, Bostic, today Mester fighting back against it, a bit of a strange one. So I'm rather expressing it via the cross, longer bit of Aussie against the euro. But that's really my main trade that I have on right now, and even that one is not a very big one. I'm really a small tad short Swiss, but not against the dollar. Well, a little in the dollar, but mainly against the CAD as well. But that could be a trade for 2024. Yeah, for the rest, just watch what those flows are doing. But I'm a little perplexed about this whole thing. Yellen the day before FOMC, then Powell going completely her way, and then even the Doves fighting against too early rate cut calls. So it's a bit bizarre what's happening there. It seems like Powell has sided with Yellen, but it did not necessarily reflect the whole tenure of the FOMC meeting.
Well, she's his boss.
Well, not in theory, not.
Well, in theory, but she's his boss.
Uh-huh.
Don't you
Yeah,
think?
that. Mm. And
Remember,
yeah,
remember 1 December where he tightened, and I think Kramer had a rant on CNBC, and then a few days later showed him in a meeting with Yellen and Bernanke, and he reversed course. So yeah,
2018.
yeah,
Yeah.
yeah. So he didn't want to do that again in December. Um, I don't know. If you're a Fed watcher, uh, yeah, it's got to be confusing. I don't know if we get anything more important from them than we do from our charts. But you have any levels in silver where you'd be interested? Say,
Uh, yeah, ideally
I
back
don't know.
somewhere. Well, yeah, those low 23s. And but ideally back into the 22s, but I'm not sure if we're gonna get it. Market is likely not going to let the dollar rise too much.
Yeah,
Yeah, I'm not even sure we're going to get there. Those 23.5 may already be enough
yeah,
in current context. Gold is also stabilizing above 2000. Been in a range here, 2020, 2050,
yeah.
2045.
I don't know what to do.
No, but the thing is what I said on the flow show as well. We're 18th of December. We're entering this period where we can speculate on stuff, but if people, asset managers, need to do some flows which have nothing to do with the data, have nothing to do with even expectations on central banks, we could go one way or the other without too much reason. So this is really, if you have good positions and you think and the market is not changing too much, you can hold them. But
Yeah,
for the rest, if on the short term, it's going to be a period of being very cautious. And when you see the money, take it.
yeah. I want to ask all you guys, can you ever remember a move in the last few weeks of the year that stuck and had follow through next year?
No.
Anything stand out over your career of something that happened in December and besides what we talked about with Paul, that
Well, we could
the
argue that
market,
2023 was sort of one.
okay,
We started 2023 around 104, 104, 105 euro dollar when we went up to 112. So I don't
okay.
know.
It
But
started,
I
the low
mean,
was in December.
no, 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 no.
Oh,
No, no, we already came in September. We already came from those
yeah,
levels sub
104
sub
lows.
parity, right?
Yeah,
Um, a move in December that's stuck in January, February. No, well,
yeah. I
no.
that's what I'm saying. It's almost like I think anything you want to do, FOMO. It's the worst thing to have right now is FOMO,
Hmm.
because I kind of think that if you know big money wants to sell something, they can generate a rally to take it there, and if they want to accumulate, they could pressure the market to be able to do that too. So it almost to me doesn't really even pay to trade this December stuff unless you know at least for position trading.
Yeah, unless you're already in since October, November, right?
Yeah. I mean,
then
new money, new trades, things like that.
yeah, for the shorter term money, I don't think it's very useful to start putting on long term positions right now. That's no.
Okay. All right. So Blake,
Yes, sir.
what did you say in your week ahead video?
I said 30
didn't-
minutes. I said 30 minutes of stuff. I actually have setups. I've got trades that are going to make your year starting right now. So if you want to
Wow.
get started, yeah, I mean,
All
why
right.
not, right?
Yeah.
And
I mean, you're
put
always
it all in today.
Well, I know you have some setups, but
Yeah,
yeah,
of course, I have some setups. Yeah.
I mean, you always do.
But
So
what's interesting, Dale, is and by the way, Ryan, you might be able to help me out with this. When did that news about the Suez Canal when did that come out?
It's been coming out pretty much all over the weekend.
Okay, all right. So
but
it wasn't like a headline from this morning.
There was some this morning. Some, I mean, we've had Maersk, Hapag-Lloyd, Euronav, all of them. BP was this morning. That was pretty much the bigger one because obviously the oil connotations. But they're all doing it. Yeah, it's just there's been this pickup in military activity in the Red
the
Sea.
Houthis are lobbing missiles at them.
Houthis, yeah, they've stepped up. Likely, it's all Iran backed, and that old palaver. But now it's just starting to impact a lot of the shipping companies now. So we need to keep an eye on that, what they do with it, whether they sort of offshore close to the Red Sea from the Asia side, and then lorry it across, truck it across to Egypt, and then reload, or whether they have to go all the way around Africa to get into Europe.
So
Wow.
I'm just pulling this up on New Zealand's Foreign Affairs and Trade website. It's 12% approximately of global trade. And here we are in North America. A lot of traders are, it's a holiday season. A lot of people are just like waking up to this and going, oh shit, well, this is actually kind of a big deal, and what you're seeing in, whoops, let me go back over here.
Who did we give the canal to?
Oh, who did we give it to?
Yeah, we owned it. We had control of it. We
Dale,
used to.
Dale, you've been around since the 16th century, so I don't remember. I'm joking.
Yeah, okay.
I don't know.
All right.
Honestly, don't know. I don't know.
That wasn't the
Panama.
Panama Canal, was it?
Panama. Okay.
Panama Canal. Yeah, this is the other one. This is the one near us, Dale.
Okay.
Yeah, this is more an Egyptian thing, but I don't know. I mean, all I know is, you're starting to see crude bid higher here. I want to say that inflation, fears might start to creep in the market a little bit. Is it going to weigh on risk? I don't know. As we come into today, I wouldn't be too worried about equities at this point. Equities are holding up, but look at this is kind of one of the things that we were talking about on Friday. This is a really tight range. The only thing that would take us out to the breakout point would be a break below this 4,700. Then we get back to this 4,650, which would be the breakout point or the highs from May of 2022. But I don't even know if that's going to happen at this point. That was something we were just discussing on Friday. As far as the markets go, this is the time of the year where you want to get out of the way. I mean, the markets are extremely bullish right now. There's no reason to really fade them. And it even with the pushback that we're seeing from, some of the, ECB members this morning weren't pushing back. There was some headlines this morning from an ECB member, right, Ryan?
Yeah, we've had a few of them. Some of the Hawks and Eagles thrown in the towel on hikes, on further hikes. There's a couple of holdouts, Holtzman and Kazakhs, but we had Wunsch thrown in the towel as well. But they're all pushing against this March cut pricing that the market seems to be into.
Casimir, premature easing worse than holding too long. So, I mean, A little bit of hawkish commentary there. But if you look at the euro, as far as the euro goes, the pullback has only been to the 38% retracement. So that's, not too bad when you're talking about the euro. One of the things that we've kind of been discussing in our community, and I think I mapped it out over the weekend. I'm not really, I have to go think about the week ahead video here, but we have a little cup and handle pattern here. If we can hold this 38% retracement right now, then that's going to set up for a cup and handle and a cup and handle, if you will. But more importantly, it's the big resistance that comes in around the 110 level. I don't think we're going to, be testing that today, so to speak. But I think it is a level that we should be watching, because if we get a firm move above the 110 level in the euro, that is a risk. And the same goes for this the dollar index, because you can see this is the cup and handle dollar index that we were talking about on the week ahead video. See, Dale, there is something we were talking about on the week ahead video. I had to go back and think about things for a second. So the dollar still remains under pressure. We can't even get back above the 38% retracement on a rebound in the dollar. That's even with the pushback from some of these Fed folks. But what's going to be really interesting is going to be tonight. I won't be in front of the computer tonight. I have an event I have to be at. But the BOJ is going to be normalizing policy starting tonight, and they're actually going to be raising rates tonight, right, Kman?
Yeah, they're going to raise the interest rates from -10 BP to +4.5%.
Yeah, they're going to play catch up today.
Yeah, they're going to put it straight away at the ECB rates, and then probably next month they are going to overtake the Fed. Put it at 6%.
Guys, this is a little bit of holiday humor, so
yeah, exactly. Nah, well, I mean, base case for me is they don't change anything, but they continue to let the wording of statements evolve towards this normalization process.
Yeah.
That is my base case. There's been a couple of people who expect that they may do something with YCC tonight again, since it's December, and Corona did it last December as well. But there's absolutely no need. If you look at the JGB 10s, they are hovering around the 65, 66 BP level. Not sure if there's any need for them to make the market more nervous than it should, and change much. So yeah, base case is no change, but continue to say that stuff is going in the right direction. We had a pretty decent Tankan as well out. So that's the base case, and likely it may push yen a tad lower, perhaps, because they don't do anything. But I'm not sure it can run too far. Of course, if they would do something, then you may have a look at the other side. But that's not my base case.
Yeah, and I mean, here's the from a technical point of view, as far as the dollar yen goes, I mean, if we got a rally to like the 144.50 to 145 level, I think that'd be a great opportunity to be on the short side. I did mention this during the week ahead video, because it would be a retest of this broken channel. We are making lower lows, and you can see how we're trading below. Well, right now we're back above, but below the 200 DMA, making lower lows. So I mean, if we got an opportunity to sell it up at 145, I think that's not a bad place to be on the short side. If you're really looking to trade around the markets, like, if we can make it back, whoops, that's not what I wanted to draw with. If we can make it back up here, I think that'd be the level to be thinking, to be on the short side. But that's grasping at straws here, trying to find things.
And also, that is if you want to have dollars in position for the end of the year. I've been saying this morning on the flow show, there may be perhaps one or two crosses who are a little more interesting or less risky. if you look at trading the yen. Yeah, I mean, up at 145, there's probably going to be people waiting there, right? Yeah, this is one.
Yeah,
That is one that I'm looking at because I'm only half believer in that euro thing, you know. Data are not supportive for much further rallies in the euro, and that is one of my candidates, that euro yen.
Talking about the euro and yeah, so the euro yen, I mean, you can see we're outside of this ascending channel, and a retest of that would take us to about 158. You can see the 200 DMA is holding us pretty well as far as support goes. So risk is manageable to the downside, but if you really want to be on the short side, maybe a limited run to 158 might be a better opportunity. So, I was thinking that about the euro and thinking about like if we do get a breakout above 110, my thought process here is that the rally would be fairly limited. We might just make it towards 111 or some change up there and set up maybe a longer term head and shoulder pattern type of look over time. So even if we broke out above 110, I wouldn't be too terribly excited about it. It looks like more of a big, at this point in time, a much bigger just kind of range at this stage. So, but that doesn't mean that the euro can't push. We couldn't get end of year dollar selling. Matter of fact, have we gotten any reports? I haven't gone through the research room this morning to look. I haven't looked at any, if we've seen any end of month or end of year flows coming through.
No, but I can tell you that based on year-to-date movements, if some people need to manage money on the back of the year-to-date moves, that one of those who should, in theory, be doing okay is the sterling. That is one that I picked up. I haven't looked at the monthly performances yet in detail. It's doing a little bit better this month, but it's still been a bit of a laggard. And euro and European and US bourses have relatively marched in tandem with one with the other. So I'm not sure whether there's a lot to do on the euro dollar side of things. Sterling maybe, but yeah, for the time being, it's looking a bit fragile. I don't know really why. Perhaps just positioning, but is one that I'm keeping an eye on for perhaps a last little rush into year end next week.
Well, and maybe we'll get a little bit of a move, and it's like right now I feel like trying to get the dollar out of the equation as much as possible for me personally. And by the way, I do want to mention that Amira, a longtime listener here on the F.A.C.E show and in our community, had mentioned some information about the Suez Canal belonging to Great Britain, but was taken from them by Egypt in 1956. Mohammed also mentioning that as well. So thank you guys. If you want to read, some of the history on the canal there. Appreciate you guys' feedback and commentary. So let me ask you guys this. Dale, let's start with you. Just kicking off the week, going into this week and what you're thinking, anything that jumps out at you that you're going to be looking at?
Well, so far I'm pretty unimpressed as well with after Friday's bounce in the dollar. That I still think there's the levels that you and I talked about around 101. There's some confluence, par 99. All right. And, possibly all the way back down towards that par level. So I think Euro has 111 in it, and I'd be booking it if we got up there this week.
All right. And I'm not opposed to that either. I kind of hear what you're saying.
And Aussie up around that 68 level, I'd be booking it too from the 5.25 low.
That 68 cents. I have a very loose trend line from the 2021 highs,
Oh,
and I
right
say
there.
loose because I drew it on a weekly chart, so I had to draw through a couple candles here to reach other candles. That's why it is a loose trend line, but that does come up around 68 cents. We're outside of this descending channel, so yeah, I mean, we could reach all the way up there, still have lower highs, and still be in a downtrend, believe it or not, in a more immediate term. So yeah, I think that's a viable target. 161% extension of the last retracement that we saw. So
there you go. A
lot
of stuff.
Yeah, a lot of confluence up there. Ryan, how about you? What are you thinking this week?
We have got quite a bit of data out this week, so it's worth keeping an eye out, just for the change in central bank expectations and so on. But I'm not really looking at getting in anything new. I'm looking to see, just in case we get a few outsized moves that come on no news, that move out the realm of what's happening in the fundamentals. I'll just look maybe to counter some of those, and if there's anything juicy. But otherwise, I'm just I'm planning for 2024 already.
All right, and Amir, did I just say Amir? I don't know why I was thinking Amir, because I think I just looked in the chat room for a second. Sorry, Kman. I don't know why Amir just blurted out there. Kman, what are you thinking do you have anything hot on the radar today?
No, really. I've been scaling down my positions really. I'm just trying to see if euro dollar can find some resistance in the 35.40 zone, but if it doesn't, then I'm out. For the rest, it's just as I said, bit short EURUSD still. I'm looking at this cable, if we can get it down to somewhere around 26, 25.70 or so, I may get in there as well. But no, I'm not looking at anything really hot to add today specifically.
Got it. Well, guys, I one thing I would keep on my radar, and I think that Jay Powell is the kicker of this one, but more importantly, some of these headlines over the weekend about the canal. I think that you guys got to be focusing on crude to the long side. I think crude could break above $75. We could probably see this 200 DMA. This bull flag that you can see is already starting to play out. We break above this descending trend line right here. It comes in around $75. Last I was looking, well, it's like 75.50. We break above that. Completion of this bull flag pattern takes us to about 76 and change. And don't forget, we have the 200 DMA just above that. And for us to reach the 200 DMA and the 50 DMA in an environment like this and some previous support would not surprise me. And like I said, it's got a little bit of a kicker now. It was something that I was looking at last week. Soon as Jay Powell decided he didn't want to be a hawk anymore, and I think that now you have another catalyst driving crude oil higher. So I think you keep an eye on crude. Inflation expectations are going to start to spike higher as we get into the beginning of next year, and that's going to make for a good central bank expectation flip-flopping, which means more volatility for us as traders here that are trading the markets, because we, especially in the currency market, as we are constantly trading on interest rate expectations changing. I think they're going to be changing a lot this next year, and that's what I'm most excited about 2024, guys. If you're not trading these markets, you got to be, because this is where it got kind of boring, like for a few months, as everybody got to their neutral rate. Like I would say middle of 2023, it kind of got boring, right? Everybody's like, okay, well, central banks are done raising, but now it's going to get exciting. And that's what I'm looking forward to in 2024. How about you guys? What do you think, Dale?
Yeah, I'm looking forward to a big bear market in the dollar in 2024.
Woo, that means the S&P is going to 6,000, and we're gonna see a blow off top, right?
Yeah,
Woohoo! I love it.
I interviewed Dave H. Contrarian. He says 7,000 is possible.
7,000 in the spoos. That would be
by
something.
mid-year.
Mid-year. Woo! My goodness. All right,
Ryan, would you buy it here, Dale, or wait for a dip?
I'm just waiting to short it at 7,000.
I'm sorry, I don't buy into that crap. I really think we're more range bound, but I think he's been right where a lot of people have been bearish. So you gotta give him that. Well, hey, I don't want to hold up your guest of honor today, Joseph Wang. I always love listening to him, and he's always great to hear his views, and I'm glad that you got him here today, Dale. So I just want to say thanks everybody for tuning in and being with us on F.A.C.E. Tomorrow is going to be the last flow show. Is that correct, Ryan? Yeah, that's correct, mate. Yeah, we're going to review the BOJ, see what's going on, and then call it quits till the new year. All right, and then for the F.A.C.E. show, we have not come up with a concrete schedule, but the F.A.C.E. show will pretty much be broadcasting almost every trading session between now and New Year's. There might Friday is, I think, the only questionable day for us, just because we'll have the Christmas holiday on Monday, and so I know a lot of people will be off shopping and doing all that other stuff, but we have PCE on Friday, so that's the other thing. Anyway, the F.A.C.E. shows for the most part are going to be broadcasting. Just make sure you're following us via social media. Make sure you're listening to us there. And with that being said, I want to say thank you, Dale, Kman, Ryan, and then Joseph. Welcome to the show. I'm gonna let you guys take over from here.
Fat Guy 12, welcome back. How are you, Joseph?
Hey, Dale. Hey, thanks for having me. It's great to be back.
Yeah, always good to have you. Why don't we start with the Fed from last week? In your view, was that a pivot?
Well, if you look at the markets, it seems like the markets are fairly convinced, right? I think we got as much as 6 rate cuts next year. So I actually
almost feels like next week we'll get all 6.
So maybe if that happens, then the market will start thinking we're going to get 12. So when I think about what happened last week, I think what happened is that, so you have the Fed chair, who probably is one of the more hawkish members on the committee, and he basically got overruled by everyone else. Now, the way the Fed works is that the Fed chair obviously has the most power, and he goes to great efforts to try to lobby everyone else on the committee so that everyone is on the same page and that there are no dissents. So, you don't really get very much dissents in the Powell Fed. What was special, though, is that you also have this thing called the dot plot, where every FOMC member is free to go and list where they think, let's say, inflation, growth, and the policy rate will be over the next few years. Chair Powell doesn't lobby for that. He lets people do whatever they want on their SEP dot plot. And I think the big contrast is that in the SEP dot plot, everyone else, the committee as a whole, is markedly more dovish than expected, penciling in 3 cuts next year. Now, I don't think Powell says that, but because this is something that happens in the future, he doesn't have a lot of control over it. And the market looked at that and began to understand that even though you have Chair Powell there, everyone else on the committee is quite dovish. And so the market's around with that. Now, there are a couple of things.
Why the pushback, Joseph?
A couple of things to keep in mind there. So like you mentioned, you got John Williams out on Friday. John Williams, president of the New York Fed, he's the 3rd most important person there. He gave an 8-minute interview with CNBC trying to walk back. Well, actually, if you listen to it, and I encourage you to, my sense was this guy was kind of nervous, and he was doing everything he can to get the market to price in fewer cuts next year. So he wanted to tighten policy a bit because he didn't want the market to price in all this. There's a prospect that all this easing could, again, reignite inflation. So he doesn't want that. But if you just listen to that, it's very obvious that this guy is just a dove. He's pretending to be a hawk for whatever reason. So I think it's not convincing, and the market, kind of kind of tightened policy a little bit, so rates went up a little bit during the interview, and then that all faded. I think that's the right thing to do because they've kind of gave the game away. People on the FOMC, people who are put in there, a lot of them by President Biden are just dovish. That's just how they think, and so that's what we see in the markets. I think that's probably the right approach. Now, one other thing that I would note, and I know you guys have been talking about currency and so forth. If you go look at what happened last week, we also got a lot of central bank speak from other central banks.
Yes.
Now, if you listen to Madame Lagarde from the ECB, she will very clearly tell you that we're not thinking about cutting rates. Now, all this, of course, is going to be done with the Fed in mind, because the Fed gave the game away and basically let everyone know that they're thinking about cutting. So everyone else had to react to that. So Madame Lagarde goes on stage, says it, I'm not thinking about cuts. We're not thinking about cuts. And I have clips on this on my latest YouTube video. And you also have the Bank of Canada Governor Macklem. He gave an interview as well. He's like, we're not thinking about cuts. Okay. And you also had the Bank of England give their monetary policy committee. Now, they didn't give a press conference, but they did vote. And they voted to uphold, to maintain rates where they currently were. But there was some dissent. It was a 6-3 decision. There are 3 people who dissented. Now, those 3 people, are they thinking about cuts? Is that why they dissented? Well, actually, no, they dissented because they actually wanted to hike rates. So what you're seeing is a very weird situation where the Fed, for whatever reason, okay, so because it's a dovish Fed, is thinking about cuts, and everyone else in the world is strongly pushing back against that. So that's why you see the dollar sell off a lot, and that's really surprising to me, because if you look at global growth, the U.S. is doing much better than any of those other places. But
one of our attendees is saying Goolsby's on CNBC. I saw him on a Sunday show, so he's making the rounds and trying to say, we're not sure. So another semi pushback on what could happen. He calls it the golden path, is where we have that soft landing.
I believe.
Does he have credibility with you?
No. He's just a political hack. He doesn't matter at all. So let me tell you a little bit about Goolsby, though. So
all right.
On Friday, he actually was on the headline on the wire saying that he'd be cutting rates in March. Okay. So Goolsby, he originally a professor at the University of Chicago, and then he was an official in the Obama administration for a while there. And when you're a part of any administration, you're basically a political player. You do whatever you are told, and that's exactly what he did when he was at the Obama administration. Just basically a spokesperson for that part, for the political class. Now, he of course did a good job, was a good soldier, and then he was appointed as president of the Chicago Fed. When he was appointed, he actually did not have the support of a couple Fed governors, because my guess is that they understood that this guy has a history of basically being a political operative. And I think that's what he's doing right now. So he's been dovish past week and probably got yelled at by Jay Powell the past weekend. So he's back trying to walk back some of his comments. But the truth is, anyone who follows the Fed knows that this guy doesn't vote, doesn't matter, and really no one respects him.
Okay. So let's get to the dollar here, Joseph. I know for the most part, since I've known you and have talked to you, you've been dollar bullish. I can't
do that anymore, Dale. Can't do that. I'm surprised I got that call really wrong, man. I was thinking that I thought a couple of things. One, U.S. growth very strong. Eurozone heading into recession. Canada heading into recession. The UK not doing that great. At the same time, all these other guys have floating rate mortgages, so their people are going to get squeezed. They're going to be under a lot of political pressure to not hike too much. But at the end of the day, it's the U.S. economy that's doing quite well. That's going to be cutting, at least telegraphing cuts sooner than everyone else. So that's a situation where I'm not in any dollar trades at the moment. So that it's not clear to me how this is going to play out.
Okay, I think that's wisdom. Let me ask you this. Earlier in your career, if you didn't know what to do with a sector or an instrument, didn't you feel more uncomfortable about that when you were younger than you do now? Because when we're younger, for some reason, we feel like we should know. And it's okay to not know and just let the picture clear up for you. So neutral the dollar, that's a different position than bullish or bearish a dollar. I know people that are saying that this is a massive top in the dollar, and that this was a pretty weak rally that we had to 104. You can see this rally here, but we're completing here. So if you don't know where it's going to go, you know what? When people ask me about currency, I'll say I don't know, and it must be okay because Joseph Wang doesn't know.
Well,
if a smart guy like that doesn't know, how could a guy who went to a state university understand?
Well, what are you guys thinking about the dollar? Dale, you're thinking about there's a big bear market in the dollar. It looks like that's what the central banks are doing right now.
Yeah,
I guess in that situation,
isn't that the Ray Dalio or the guy from Bridgewater? That was his biggest trade, being short the dollar. Now, I think we could get a bounce from lower levels, but why can't we have this from where we started here at 107.40? Could take it a lot lower, and wouldn't that be a way for economic weakness to be kind of camouflaged and the market even do better because of a weaker dollar being more of a tailwind for the market than a strong dollar being a headwind?
Yeah, a weaker dollar is positive for equity markets in the US and very positive for global growth. So globally speaking, the dollar is the reserve currency. A lot of people use it even though they don't live in the US. So when you have dollar rates and dollar currency weakening, in a sense, you're loosening credit conditions for all these other foreign companies that have to borrow dollars or use dollars. So it's very much growth positive globally and stock market positive. So, but I would also just note one thing though. So the market is probably getting ahead of itself, pricing in all these rate cuts, and you have two things that could derail this dollar bear market. One is that because rates have eased so significantly in the US, you actually see another wave of inflation that forces the market to also price out these cuts. That's in price in a higher rate trajectory. So US dollar rates go back up, dollar strengthens again. So that's one possibility simply through inflation. The second possibility is that you have all these other countries who actually do end up in significant economic distress next year, and they end up chasing the Fed and cutting rates as well. So that's a couple things to keep in mind. But again, these are just potential scenarios. What you're talking about, you guys are, the trend is your friend, right?
Yeah. So, I'm looking at this 10-year, and this has been a pretty good move, right, Joseph, from 5 to, where we're at now, about 390. And I just think it's possible that yields just don't drop like everyone's thinking to 3 or 2.5. But maybe what you're talking about is starting to happen in the Red Sea, because lower oil prices has really been a boon for inflation coming down. And if there's a problem with the supply chain of getting tankers through the Red Sea, etc., they have to go around Africa, that maybe oil could contribute to that. But wouldn't a weak dollar also contribute to inflation, because nominally everything costs more because of weaker dollar? Dollar goes down 10%. Metal prices could go up another 10% just based upon a falling dollar.
Yeah, and you see that the past week, right? So dollar weakens, you see gold going up and you see oil going up. So these global commodities, they usually trade inverse to the dollar. Now, it's not the only thing that matters, but you're right. Giving a weaker dollar is a tailwind for commodity prices.
Okay. So when I look at yields, can you come up with any case that people are proved wrong, even the Fed, like in the 70s, where they thought they had victories, and then they found out they didn't, and they had to embark on a campaign again, where everyone thinks this is a high in yields forever, this 5% level, and that somewhere in here we base out and next year we make new highs in 10-year yields. I know there are still some people looking for higher rates.
Oh yeah, that's me actually. That's me.
Oh, okay. Is that
That's
part
me.
of
No,
what you write about, like
that is part of
reflexivity?
what. So listen, for me, I believe that we are in a structural bear market for rates. That is to say, yields trend structurally higher, and from what I see, there's just really no way around that. That's just my highest conviction call. May not pan out tomorrow, but structurally, this is going to happen. I don't see any other way this could be otherwise. You can look at it in a couple ways. You simply take a graph of the U.S. deficit, expanded 7% now, projected to expand without bounds going forward. You know, like anything else, rates are just supply and demand. You have a lot of treasuries being issued. If you want to look at it from a more fundamental perspective, you know, that is inflationary, and we are going into a world where our workforce population is not growing at the same rate that it used to. Got boomers retiring, and remember, people had smaller families in the 1980s. So we're going to have upward pressure on wages for the foreseeable future. We've already seen that, right? Pandemic, we have a lot of boomers retire earlier than expected, and wages zoomed higher, unemployment zoomed lower. That's a structural feature of the economy simply because of demographics. So I think that's going to keep inflation elevated as well. Now, I know there are a lot of people who think that rates only go lower, we're going into structural deflation and so forth. But, you know, I think that there's a lot of people who grew up in 2 decades of a bond bull market, and that's heavily colored how they view the world. But I believe that the future will not look like the past. And so, you know, this is, I think this is just a correction, and we're going to go higher, and we'll see higher highs in treasury yield, 10-year treasury yields next year.
360. I mean, 569, 570.
For in the 10-year, I think we can. Well, we'll definitely be above 5%. I think that, but so it's not going to be a straight line, right? I think we could touch 5.5, but we're going. It's just not going to go straight up. It's going to be like it is this year, like all assets are. You go up and then you trace and then you go up again. But I think we'll end the year above 5% next year in the 10-year.
So what about people that are afraid that they're going to miss a rate window, you know, at 5%, and they're coming into the bond market? I've talked to someone that said that this rally in bonds is a risk-off rally. Do you agree with it, or just a short squeeze?
Well, it could definitely be a short squeeze. I think you can to risk off. I'm not sure. It looks like equity markets are really risk on. So that doesn't seem to be consistent with that.
Yeah. You think it has legs like a lot of people do? I mean, this was one hell of a bear market. So can we get this bear market rally to keep going? I mean, even up to 120? Some people are calling for it.
I don't think so. So when I look at the 10-year, I mean, I think we could go as low as 3.5. I don't think we'll get there, but I think I don't think we'll get there. I think we could probably be between, you know, maybe base around here, actually, maybe base around here, 370, around this range. What really surprises me is the 30-year. The 30-year it's at 4% now. I would be really surprised if it would go much lower. It really doesn't make sense for the 30-year to be there where it is. From my perspective, on the one hand, a 30-year just doesn't have a lot of demand, and we're going to have a lot of issuance in the coming issuance cycle. On the other hand, you know, there's talk about the Fed changing the inflation target. I think they will. And if you are someone buying a 30-year bond, you have to keep that in mind.
Okay. Why don't we talk about your writings about Crash Up? I didn't delve into it, but I love the title.
Yeah.
And
so
I'm assuming you're talking about equities having to crash up.
Yeah, I'm really bullish on equities. So, so I think, again, the way that we view the present and the future is often colored by our past. And if you are a trader like anyone here today, you lived through the COVID crash, you lived through the 2008 financial crises. These are all crashes to the downside. So that's how we color our perception, right? We're always worried that somehow everything is going to fall apart, and you know we're going to be down, limit down 7% or something like that. But I think the risk right now is that we actually crash up, is that we have a rally. And maybe like David Hunter says, we go to 6,000 or something higher than we expect. I think what people don't fully understand is what it means to have a deficit that is about 7% and getting larger. That's not something we have to deal with in our lifetime. At a very high level, and I explained this in my post, deficit spending in the modern financial system is mechanically equivalent to just printing money. Usually you have mechanisms that dampen on the inflationary effects of this. You have central bank, you have a bond market, but all those guys, for whatever reason, are not pushing back against this. And so you have the possibility of some serious upside in equities in this setup. Dovish Fed, massive deficit spending, economy does well, bond market still delusional. So I think I think that's part of the reason why equities continue to go higher, and I think next year will be a really good year for the S&P 500.
David said this is the end of a long-term cycle. I don't know if it goes back to I consider the beginning of this bull market August 1982. We were at 660 and in the Dow, and that's a long-term, that's a 40-year bull market. So there is an expression, and you've seen it as a trader, the biggest moves come at the end, right?
Well,
you got blow-offs.
Yeah,
parabolic.
Parabolic. The moment you see it going up every day, it being unstable and volatile, that's when you got to be careful.
Okay, so do you ever buy any VIX protection for your long positions? Do you ever hedge your long positions in the market?
So I hedge. So a lot of my exposure to the upside is through call options right now, and so that's kind of how I hedge, because you just lose the principal. I lose the premium. If you look at the volatility, it's quite low right now, so options are quite cheap. So that seems to be a good way to put this trade on.
Yeah, that's amazing too. With this kind of move, the calls are cheap too in the S&P. Okay.
Yeah.
All right. Anything else you want to talk about? You talk about the inventory, and you also talk about there'll be regulation will increase until liquidity improves. Is that the bill that Jamie Dimon is so much against that they're trying to pass, Joseph?
Yeah, they're there. I hear they're taking on ads at football shows too, just to get that message across. It's really a full court press in the banking sector to stop these new regulations. So there's these new set of regulations called the Basel III Endgame that's basically going to make life harder for banks. It's going to increase their costs, their regulatory costs. And that has impacts on markets as well. So when you buy and sell, let's say a security, it's usually you're facing a dealer, and a dealer has all these regulatory costs. The higher the regulatory costs they have, the less likely they're going to make markets. And that's why sometimes when you have these extreme events like COVID, you can have markets where even the treasury market freezes because everyone goes to sell their treasuries, but the dealers, because of the regulatory costs, get maxed out and aren't able to take the other side. So you could have more volatility in markets if this actually passes, because there's going to be less liquidity. I don't know how this will pan out. It really does seem like a very strong marketing movement to try to get this Basel III Endgame scuttled. But that's just something to think about. Just structurally, again, everyone knows this. There's less liquidity today than there was before the financial crisis in 2008, and that's largely due to regulation. And the trend is that this will get worse.
Right. I've heard people complaining about liquidity in the bond market, which used to be the deepest and supposedly still is, that we already have that going on structurally in the bond market.
Yeah.
Where, you used to be able to get off a trade for the spreads were tighter on buys and sells on market orders. Now there's maybe a 2-point spread. Used to be a decimal point.
Yeah, no, that's going to continue. It's going to continue. It's just, well, you can think about it this way, right? So you have a stadium, and you have so many exits. Now, the stadium, let's say that's the treasury market, it gets larger and larger and larger every year because of all the deficit spending, but the exits, that's the dealer capacity to make markets, that doesn't actually really change. So just
they
as a
still have
stat for you.
One
Yeah,
door
just
still,
like a stat for you. So in early 2000s, the treasury market, the size was about $7 trillion. And the daily cash volumes in the treasury market were about 400 billion a day on average. Today, the cash market treasury is almost 4 times as large. So it's like $25 trillion. But the daily average volumes in the cash market, it's about 600 billion. So the cash market, 50% larger on the daily basis, but the overall outstanding treasuries is almost 4 times as much. So it's that classic mismatch. Stadium gets larger, exits don't get larger. And so liquidity mechanically has to get worse, and that's going to continue.
Okay, I know that you keep one eye on geo events. You and I have talked about Ukraine quite a bit. And, you know, since we've last talked, we have a new theater of war in the Middle East that may or may not escalate. And recently, we're not able to get funding together for the Ukrainians. Now, where do you think that's going here, Joseph, with an election year coming? And is it the best thing that we let that go and let Ukraine fend for itself? Or should, you know, the U.S. still support them?
So what I see happening politically is that everyone believes that if the other person wins, it's going to be an existential crisis for the republic. And you see this again in think pieces by mainstream media, right? Oh my God, if Trump wins, it's going to be the end of democracy. It's going to be fascism and so forth. Anyway, there's a lot of messaging going on that raises the stakes for this election. Now, if you are someone who perceives this to be an existential crisis, then you're going to do whatever it takes to win. And whatever it takes could be just going off, being a, you know, being a Fed official and signaling big dovish things, or it could be to escalate geopolitics to try to get people's mind off of other things or something like that. So I think there could be a lot of crazy things happening next year simply because a lot of people perceive this to be such an existential event. I think that traditionally speaking, if you have a war, it's positive for the incumbent. So the Biden administration always liked wars. You know, we're starting wars everywhere. You know, maybe that continues to escalate. I think that's part of the reason why President Biden is so desperate to get more funding for Ukraine, because he just wants the war to continue. What I read is that they're willing right now. They're willing to make a deal with the Republicans, where Republicans get funding for their border stuff, and Ukraine continues to get money for their war. So I think they're going to want to continue this war throughout next year. That seems to be always what they liked.
And do you think that now with the I don't know in currencies, that if you could find a spot tactically, you should own some gold in this environment and silver?
Yeah, I own some gold. Silver, I don't know as much. You know, silver has been doing well, you know, but, you know, it's part precious metal, part industrial metal and all that. So gold seems to have been holding up pretty well. We hear that there's more central bank buying, but again, if you're heading into a world where the dollar is weakening, then gold is going to perform well. I think the broader picture, though, is that inflation really has come down. So we are moving into a global cycle where central banks will gradually be cutting rates, probably not as much as priced into the markets, but we are moving away from a globally synchronated rate hike cycle to a globally synchronated rate cut cycle. And gold, I think, usually does well in those scenarios, as does equities, of course.
Part of this easing, could any of it be maybe a growth scare as part of the rates coming down for a bit longer? Is it possible?
I think it depends on the country. I think a lot of the other central banks are looking for growth to slow, hoping for it to slow, because they want inflation to come down. So if growth slows, I think that will make them happy, and I don't think they will cut rates to stimulate their economy. I think it's mostly focused on inflation right now. So if inflation comes down.
I don't think China has inflation problems, do they?
No, no, you're right. They're the one country in the world, one of the few countries in the world that are having economic troubles, right? We've all read about their property bust and so forth. I wouldn't worry about them though. Their government has a lot of tools that Western governments don't, right? Like if any company is about to go bust, the government, which basically owns all the banks, can just order them to continue to lend and keep the game going. So it's very much up to what their political class decides to do.
Okay, so you don't think problems in China would bleed over to the to cause global slowing?
No,
they'll
is
handle
so China is a big exporter, right? So they're not a source of demand, they're a source of supply. So when the US economy picks up, then there's more activity in China because Chinese sell more stuff to everyone else. So I don't think of their activity as a driver of global growth so much as that everyone else's activity drives Chinese growth. Remember, China sells to people. They're the workshop of the world. They are not a source of global demand.
Okay, Joseph. Well, I just want people to know where they need to go to read your stuff, and you do a couple of courses, Markets 101. So you have a new course. What's in this new course, buddy?
Oh yeah, so I have this set of courses. It's basically I teach about the different asset classes in the financial markets, how to look at them from equities, central bank policy, rates, and things like that. It's check it out. The first course is free, actually. It's basically when I was at the Fed, everyone who is a new person to the Fed goes through a training program as to how to look at markets, and I take that and I recreate it and share it with the broader public.
Okay. Well, much to offer, a lot of knowledge to share.
Yeah, Joseph, also, just one thing I would plug. So I have a YouTube channel where every week I talk about, I review what happened in markets. It's called Markets Weekly, and my channel is called Joseph Wang. So check it out if you're interested in just weekly macro recaps of what happened in markets.
Okay. So YouTube in it. And Joseph, happy holidays to you. And I hope 2024 is a great year for you and your friends and family and people that you teach and all your clients, that it's a banner year for you.
Thanks so much, guys. Merry Christmas, Happy New Year, and we'll talk afterwards next year.
All right.
Best
Fed
luck,
guy,
everyone. Happy trading.
Fed Guy 12, follow Joseph. Learn what he learned at the Fed. He's sharing it. Take care.
Bye,
Adios,
guys.
Joseph. So that's a wrap, everyone. You could join the team in 13 minutes on the Morning Edge. Remember, don't just count your pips, count your blessings. And we'll see everyone for Turnaround Tuesday. Adios.